Good morning, everyone. This is Jim Vaughn with Malden and Jenkins. I have just a minute or two after 10. We have a few participants on the line, so I thought I'd give us a couple more minutes in case people are running late with it being Monday morning. Well, good morning again. It's Jim Vaughn with Malden and Jenkins. I'm a partner in our Chattanooga office, and I practice mainly with financial institutions. I originally gave this presentation with a business partner of mine at a bank convention in Destin, Florida. And we thought we'd adapt it to a webinar because we had such good feedback and there seemed to be some useful information to bankers on here. When I was originally called and asked to speak, the Tennessee Bank Association director asked what I would talk about. And I said, well, isn't the thing that everyone's talking about, isn't it COVID and how it's affecting things and the effect it's going to have on the economy and accounting and numerous other things. And he said, yeah, that sounds like a great topic. Why don't you do that? I said, okay, I will. And so we've kind of put this together in a rather informal way as just more of a discussion about things to be aware of, not necessarily a heavy, very technical reference guide. And so I thought I would just kind of mention a few things that I'd seen in my travels and kind of bring you up to speed on how they're going to affect you guys. So the topics I kind of planned to discuss were, I saw a really great slide on where the distress was in the collateralized mortgage-backed security world. So I share some information about that for you. And I also went through a lot of public SEC filings to see kind of what the themes were in 10-Qs, to see what industries were affected, how we're affecting allowance builds, what balance sheet areas COVID was affecting, and just kind of generally what the public disclosures out in the marketplace were regarding COVID. And I also thought it'd be kind of interesting to see, since large public companies have adopted CECL, what the effect of CECL would be on allowance and how provisions in the first and second quarter had been in public information. So we kind of see what public companies were doing. And then when we're in times of economic distress, the first thing you think about is, where's it going to affect my balance sheet? What loans are going to be affected? And the second thing you're going to be is, well, how much do I need to build my allowance? And the third kind of thing I would think about is, where will we see impairments in our balance sheet? Will we have goodwill issues? Will we have deferred tax issues? And so we're going to talk about a few things like that. And then the last time we had a serious time of economic distress. There were some subsequent event rules that were changed regarding issuing financial statements. So I thought I would just remind you of those because they seem to have a big impact. 2008, 9, 10, 11, 12, when we were trying to issue financial statements. So I'll just have a brief reminder of what those rules were so that catches us off guard or by surprise again. And then how could you talk about COVID if you don't talk about the 3P loan program? So have a few updates regarding it, just a few generalizations, a couple of reminders. Also along with the response to COVID was the CARES Act. And in the CARES Act, there are a few tax updates. And so I thought I would bring those to your attention just so you can do some planning or thinking about, see if it affects you, or just keep them on the front of your mind in case they become relevant. And then also in the CARES Act, there were some statutory relief for borrowers where you could grant loan modifications. And also there was some interagency guidance on loan modifications. So I thought I would walk you through that briefly just so you can stay abreast of what's going on there. So this was a slide that was put together by Moody's Analytics, and it was originally shared at the AICPA National Conference on Banks. And what it's showing here is an $8 billion collateralized mortgage-backed security. And the graph is showing where there's distress in this security. So if it's past due or if it's asked for a deferral of payment. And so inside this $8 billion security, so if it is past due or has asked for a deferral, and you combine the population of that, 47% of that is related to lodging and 38% of that is related to retail, with mixed use, multifamily, and office just being small, 5%, 4%, 3% respectively inside of that security of those that are behind on their payments or have asked for a deferral. So overwhelmingly, the two biggest areas to be concerned in this security are lodging and retail. And I think when we get to the next slide and kind of discuss what the public disclosures are related to distress in the current environment, you'll see this theme starting to mature. So this is a slide where I've just gone out to Synovus, ticker SNV, and looked at their investor presentation from 7/21. And all I've done is regurgitate exactly the industries that they have labeled as sensitive to COVID-19. And they had a really comprehensive list. And so then I went out and looked at other Southeastern regional banks to see if they had similar slides in their investor presentations, and they all did. And the theme was overwhelmingly the same as it is here. And so I just used Synovus because it was the first one I went to. And then all the other ones were very similar. So industries particularly sensitive to COVID-19. Number one for them were hotels and non-resort hotels that were franchised. And so, I think you can infer from that it's mostly hotels that have been affected by business travel. One would imagine, Las Vegas, places where there has not been resort travel, because right now, if you go to the beach or you go to the mountains, it's packed. 2 weeks ago, I was down in Destin, Florida, and it took forever to get down there. The traffic was horrible. Every place was crowded. And so, one could infer from that also is that resorts are doing well. I took my kids to Dollywood for our first outing, after COVID, probably 2 months ago. And Gatlinburg, Pigeon Forge, Sevierville was crazy packed. And so, but, if you look across the street, here in downtown Chattanooga, the business hotels, the parking lots are empty. There's nobody walking around just because business travel has been brought to a standstill. So, and then as I've discussed with my clients, those that have had ongoing regulatory exams, the regulators seem to feel that if you have a hotel loan, the burden is on you as the financial institution to prove that it's good, and they just automatically assume that it's bad. So keep that in mind as you're doing loan reviews or documenting updates to loan files related to hotels. And then shopping centers that don't have a grocery, a pharmacy, or a discount anchor tenant. So any retail center that does not have something that people are going to regularly. Big box retailers like a um, uh, clothing store, would probably be those to watch. Those you wouldn't worry about is if you've got a liquor store and a grocery store in a strip center, because people are going there every day. Uh, and then be cognizant if you've got restaurants in your portfolio, as those have been hit with 50% limitations, 25% limitations on occupancy, 75% limitations on occupancy. They've been closed for a while, and then just retail that doesn't involve gas or staples. Those have been hit extremely hard. Online retailers have been booming. In-person retailers have not. Other places that have been experiencing distress are fitness centers, recreation areas, entertainment, churches. They haven't been, at full occupancy. People have been scared to go places, for leisure. Country clubs, other than the golf side of those, have seen tremendous pressure. Golf courses have been packed when they've been allowed to be open, because it's outside and people can social distance and be responsible in their personal lives. So if you can see, I'm kind of crafting a tale of, if we were sitting down and I was your auditor, and, we were having a discussion, before the audit began, of things to be concerned about. Hey, do you have this in your portfolio? What have you done to mitigate the concerns here? Have you had significant deferments in these categories? And then the next thing I talk to you about is, well, what are you thinking about what you're going to do with your allowance? Most of my clients have taken the income that they receive from the 3P loans and use that to offset their reserve builds. And so they've been building their reserves, because we know something bad could happen. We don't know exactly when or how or when it's coming. There's been so much government stimulus from the 3P loans, from the additional unemployment benefit, that I don't think we've quite seen all of this hit just yet. I know we have seen distress in restaurants and hotels and some other industries, but I think the huge amount of government stimulus that's out there has put quite a deferral on our economic distress. And so, as soon as that starts to subside, and we're getting towards the end of it now, I think you're going to start to see the chinks in the armor play out. And as such, I think it's time to start, if you haven't already, to consider, building your reserves to take that into account. So this slide I plagiarized from a chief accountants panel at the AICPA National Convention. So it was the OCC, FDIC, and Federal Reserve chief accountant, and then a moderator. And their staff had put together the effect of the adoption of CECL versus those still on the incurred loss method. So those that adopted CECL ranged from 1.3 billion to 3.1 trillion. The CARES Act allowed for you to delay adoption of CECL, and 23% of those eligible elected to delay. At 12/31/19, prior to the adoption of CECL, the average allowance was 0.89% allowance to total loans. So just, 90 basis points. And then after, so on 1/1/20, after the adoption of CECL, those average allowance to total loans was 1.21%. So basically a 36.4% increase. And you've heard numbers all over the board for the last 4 or 5 years about what the actual effect of adopting CECL would be. And there's some good qualitative evidence of what it is. It's in the range of 30% on average for those. I think if you got a retail portfolio, a mortgage portfolio, it could be higher. If you have just a commercial portfolio, it could probably be less, depending on what happens, in the economy going forward. So at 1/1/20, we were at 1.21%. And then the average allowance to loans at 3/31/20 was 1.47%. So we had an increase of 26 basis points. And so I think that is directly attributable to COVID. And then also, if you look for the next quarter, at the end of the period ended June 30th, 2020, they're at 1.66. And so I think COVID is still on their mind, and they built their reserves another, 21 basis points. And you also had 3P loans in there, probably blowing up the balance sheet a little bit. So, if you look further down, the provision expense for quarter one was 44%, and provision expense to average loans for Q2 was 0.35%. And you compare that to, the incurred loss model, the model for non-public companies, you don't see quite those reserve builds. And I think it's mainly driven by the fact that CECL is forward-looking and the incurred loss model is rearward-looking, and there just haven't been any historical losses for years. And so unless you're really juicing up your qualitative factors, it's hard to get those allowance methodologies to show that you need enough reserve to really take into account the potential effects of COVID. And so I don't like CECL mechanically. I don't like how it's been presented by the AICPA, by FASB, by the regulators. But I do think the theory in it is good. I think it's just too complex for financial institutions other than those largest in the nation. But I do think the theory, and you look a little bit forward. So if you see something like COVID out there on the horizon, you can provide for it. I think that's where CECL is effective. And I think that's why it has been pushed by FASB to adopt a model like this so that you could account for things as they're coming down the pike, not reactively. So I think that's enough about allowance. I think everyone here would agree that there is distress in the marketplace. And, I think we've shown the data that suggests that financial institutions are building their reserves. So let's talk about where else we could have issues this year or next or in the future. And I think the first place we would look to would be goodwill. So if an event occurs or circumstances change that would more than likely not reduce the fair value of the Borden unit below its carrying amount, you could have an impairment. And the items to look for that those events are a change in macroeconomic conditions, a change in industry and market conditions, a change in overall financial performance, or a sustained decrease in share price A. So is COVID a triggering event? Well, let's look at a case example. So macroeconomic conditions. So I went out and I pulled the unemployment rate at the end of August. It was 8.4%. And at the end of the year, 12/31/19, it was slightly less than 4. So unemployment has more than doubled. So I would say that macroeconomic conditions have deteriorated. Industry and market conditions, we've kind of shown what financial institutions are doing and what they've done with their allowance. And so when you're building allowances, one could also occur that there is stress in the marketplace. Overall financial performance, I think if you look out at the big public companies, what they've reported for the last 3 quarters, first quarter, second quarter, and third quarter. Well, let's exclude the third quarter. First and second quarters, net incomes were way down versus the prior year. And so you obviously don't have the same level of financial performance you had last year. And then sustained decrease in share price. So as of 9/23/20, Synovus was down almost 50% for the year to date. And the KBW NASDAQ Bank Index was down 38%. So there's also tremendous stress on share prices right now in financial institutions. And so I think it's time to really look at goodwill and come up with a plan of how are you going to deal with it year in, because there is the serious potential for events out there that could cause or could trigger or should definitely make you evaluate goodwill to see if there is impairment. And I won't read this to you, but this is the exact disclosure that came out of Synovus's 6/30/2020 10Q, where they did go farther than just the first step in evaluating goodwill, and actually didn't just evaluate it from a qualitative standpoint, they evaluated it from a quantitative standpoint. And although all these conditions were present, decreased share price, um, stressing out there when they mechanically calculated it, there was not any impairment, but that doesn't mean that there won't be some in the future. So they had to go farther than they have in previous quarters to actually calculate it, but they didn't have any impairment. And so I think that would lead me and others to conclude that this is going to be a continual quarter-to-quarter involvement for the foreseeable future until things improve, and that there could potentially be some impairment out there in the future if these calculations or if their inputs and assumptions change into their modeling. One other area on the balance sheet to be concerned of is mortgage servicing rights. So if you have a significant amount or any amount of mortgage servicing rights, the market conditions for those have changed significantly in 2020. There's been a drop in interest rate. Prime's down 50 basis points. The 10-year Treasury is at historic lows, or if not at historic, it's very low compared to how has been the last 4 or 5 years. And then there's been an increase in delinquency. And so you take delinquency risk and a drop in rates, and that puts downward pressure on mortgage servicing rights values. And so if you've got downward pressure on values, you have the potential for impairment. So, most people outsource those valuations to third parties. So just be in constant communication if you have any amount of mortgage servicing rights on your balance sheet, and talk to the folks that do those calculations for you, and see where they think those will come in, and see what kind of potential problems you might have for those between now and the end of the year. And then I don't think we're at the point in the economic cycle where we really need to talk about deferred tax valuation allowances right now. But when you start building reserves and you start having goodwill impairments, the next logical step probably a year later is you probably have some net operating losses. You could have some decreased performance. And so just remember there is the potential for deferred tax valuations allowances, in these economic downturns. And so I just put that on your radar. I don't think we'll have those type of issues in 2020, but you could potentially have them in 2021 and 2022 if things don't get better. And then in our last economic downturn, they changed the subsequent event rules, and it really made it hard for auditors and preparers to get out financial statements because of one particular type of subsequent event. And I'll take you through the two types and just kind of re-educate you on those matters, just to be aware, because it could cause things that make life a little bit tougher on auditors and financial institutions. So there's a type 1 subsequent event. So that is an event that provides additional evidence with respect to conditions that existed at the date of the balance sheet, and information becomes available prior to the issue of financial statements. For example, the receipt of a loan or other OREO appraisal. So if you had an impaired loan and you got a new appraisal and you got it in January, you've already prepared your financial statements, you've already booked net income, and it's additional reserve that needs to be provided. That's something, if it's large enough and material enough, you have to open up the books and rebook that. And that's not fun for anyone. Same with OREO appraisals. If you had a piece of other real estate on your books at 12/31, you got an appraisal on March 15th, and you're going to release your financial statements on March 17th, and you had $1 million worth of impairment there, that'd be something that you would need to consider whether or not you need to book it. The rules say you do, so you just have to determine, if it's material, if you agree with it, if it's something you need to do. And then type 2, these are much easier for everyone here because it's just something that provides additional evidence to respect with conditions that did not exist at balance sheet date. For example, if you did a capital stock raise, you just disclose that in the last note in the financial statement, say, hey, after 12/31/2020, we raised $20 million in equity to go do an acquisition or something similar to that. So type 2 is much easier to swallow than type 1, and type 1 causes for a lot of tense moments between auditors and their clients when these rules were initially adopted. Hopefully, now that everybody's been reminded, it won't be quite as difficult of a conversation, but no one likes it and no one's happy at the end of those. And eventually everyone understands it, but it's just a very tough conversation. And so I remind you of that just to keep it on your radar. We've probably been 3P loan program to death. And this program seemed like it came out in a millisecond, and the rules changed every day, every few minutes. And I believe they still are. But I thought I'd just hit the very key highlights. And if anybody has a technical question about it, I'll be happy to help you offline, or after the seminar, or you can email me a couple of days from now. I'll be happy to help you with what I can. But the advance from the 3P should be accounted for as a loan from the date it's funded until the day you receive the money from the SBA. There's no SBA receivable in there at any point. And so just know that it is a loan until the day you receive the money from the SBA. The SBA and guarantee is embedded and should be considered in estimating credit losses. And so it is a 100% government guarantee. Well, not. It has a government guarantee from the SBA on a loan that is embedded. And so, the part is guaranteed. You probably shouldn't have to provide any reserve for it. And then the origination fee from the 3P loan should be accounted for under FAS 91, which means it should be offset against, which means the loan origination cost should be offset against the fee, and it should be deferred to amortized over the life or estimated life of the loan as an adjustment to the yield. I know I have had some clients, and I know of other financial institutions that have just booked those into income as they have received them. And so just be prepared to defend that, because the examiners are looking at that. For most institutions, because you net it against the deferred cost, and they're kind of short term, you could probably get to an argument that is immaterial with both your auditor and regulators. And I actually have assisted a client in doing that with the OCC, but we had to have a discussion with both the EIC and one of the chief accountants, one of the regional accountants in Dallas with the OCC, and I had to help our client draft a very detailed, long memo. But we did get to that answer, and the OCC did concur with our conclusion, with my client's conclusion. And so, just keep that in mind as ways around it if you did in fact book those into income incorrectly. So under the CARES Act, there were changes to the NOL rules. So I guess roughly in the past 5 years, we've had 3 sets of NOL rules. We had the original, so you carry back 2 and forward 20. And then the Tax Cut Jobs Act changed that, where you could not carry back NOLs, but you could carry them forward indefinitely with only a certain amount excluded each year. I believe you could carry forward 90, you could use 90% each year going forward forever. But there's different circumstances for those. And then when the CARES Act passed, they reinstated the corporate NOL carryback provision. So for NOLs arising in 2020, you can carry those back 5 years. And so the years 2020 NOLs could be carried back against are 19, 18, 17, 16, and 15. And the key planning item in this is for years on the slide with an asterisk, those are at 34 or 35%. So those are more valuable than today's NOLs. So if you can carry them back against 17, 16, 15, 14, or 13 years, those are at a higher rate, so they're more valuable. So just keep that in mind. So the CARES Act allows you to carry back NOLs 5 years. And there's lots of planning and lots of complexity in these rules. So if anyone would like to discuss this offline, I'd be happy to help you, or talk to your tax accountant about these, because there's significant potential for planning in these. Also, as a reminder, we have election in it's just about a week, and something changes. The challenger in the race says that he is going to raise taxes. So just remember, if taxes go up, it affects the valuation of your deferred tax assets. And so a change in tax rate affects DTAs, and it creates book income or loss. The last time rates went down, and there were book losses. So if rates go up, you should have book income if you have DTA. And also, as we've talked about the reserve builds in previous slides, just remember that if you have an S Corp bank, or if you have a bank larger than 500 million, or if you're on the reserve method, also probably if you're building reserve, you're probably going to increase the size of your DTA related to the allowance for loan losses. And so just keep that in mind, as you're looking at the valuation of DTAs, the potential for a valuation allowance on DTAs, and if a change in tax rate affects your DTA and the value of it. And now I'm going to quickly take you through what I think is a great reference guide for loan modifications. It was put out by the OCC. So just give me a second while I change my screen around a little bit. Right, so this reference guide was put out by the OCC. It's available on their website. You can just Google OCC reference guide, loan modifications, and this pops up. And so there are two ways a loan can be modified. One is under Section 413 of the CARES Act, and the other is under the revised interagency statement. I would suggest modifying under 440.13 of the CARES Act, because it gives you greater flexibility. And if you look to this chart, you can see that. So there are much less stringent requirements to modify a loan under Section 413 of the CARES Act than there are under the revised interagency policy statement. So let's just run through this chart quickly. So does the bank intend to elect to account for a loan under Section 413 of the CARES Act if eligible? And so if it's yes, you just have to modify it due to COVID. You have to modify it during this time period, and the borrower just has to be current as of 12/31/19. And you can modify the loan. You can grant a deferral, and you will not have a TDR. That does not mean, and the regulatory agencies have been very clear, that if you grant a modification, that does not mean you don't have to effectively risk rate that credit still. You don't have a troubled debt restructuring that you have to report, and you haven't automatically created an impaired loan, but you do need to consider the risk rating of that loan. And then if you choose to modify it because it's eligible under the revised interagency policy statements, then the modification must be due to COVID-19. The borrower had to have been current when the modification program was implemented, and the modification has to be short-term, for example, 6 months. And then you may modify the loan and not have a TDR. If not, then you must consider your existing accounting policies related to TDRs. So questions or comments? That's all I had for today. I put up my contact information and my phone number. If you have additional questions, I'll be happy to help you with anything or walk you through any of this or give you a little more information. I really meant for this just to be a quick reference of things to consider. But I'll be more than happy offline to help you with any of the real technical issues in the material. Well, it doesn't appear if there are any questions. So I'd just like to thank everyone for their attendance. And I hope you enjoyed it. And if there's anything I can do to help you in the future, please feel free to email me or give me a call. I will send out the slides and some additional reference materials to those that were on the webinar. And I thank you for your attendance and your attention. Thank you.